Hello and welcome back to Kitco Mining's Digging Deep with me, Paul Harris, in which we take a closer look at some of the most interesting news items in the mining and exploration space. Joining me today is Nicole Adshead-Bell of Cupel Advisory. Nicole, welcome back to Kitco.
Thank you very much for having me again, Paul.
Now, we have had a full week of first quarter results. Some key takeaways. Lundin Gold continues to break records with an all-in sustaining cost margin of more than 60%. That's about $2,000 per ounce. Most companies are using their surplus funds to aggressively buy back stock, yet higher gold prices seem to be papering over some of the many cracks as production continues to slide. The 9 majors produced on aggregate 1.5 million ounces less in this quarter than in the December quarter, and more than 1 million ounces less than a year ago. The mid-tiers were down too, but by a smaller amount. Nicole, what takeaways do you have from this first quarter?
M&A, I think, will continue to be the name of the game. We're in, I would argue, the phase of the commodity cycle, given the very, very strong gold prices that we've had, where investors are moving away from focusing on balance sheet and dividends and returns and saying, where is the growth coming from? And so I think you'll start seeing, and we have seen it obviously, but I think you'll continue to see M&A frenzy going forward.
Now, Barrick Gold CEO Mark Bristol, during his conference call this week, continued to poo-poo the M&A idea, saying something to the effect that high gold prices mean projects today that were marginal a year ago are now in play. As I mentioned, Nicole, a lot of companies are being very aggressive with their shareholder returns, favouring buybacks rather than dividends. What do companies look to do by buying back their own stock that they cannot do by paying dividends?
Buying back your own stock is a very visceral demonstration that you, the company, think that you are undervalued. And so if you're undervalued, one of the most creative things that you can do is to invest that excess capital in terms of buying back your shares. I think that becomes less attractive to investors when you're in the growth part of the cycle and they're focused less on balance sheet and what are you going to do with that excess capital. And so I think we're moving away from a focus on buyback of shares and dividends. The thing with buying back shares is it can be one-off periods of time, whereas if you dramatically increase your dividends, for example, and you have a material rapid decline in the gold price and you have to decrease your dividends. And so chopping and changing your dividends is often seen from a company's perspective and perhaps also an investor's perspective as being less favorable.
I can understand the logic and the reasons for having a stable, consistent dividend because it means people can plan, etc., etc. But if people are investing in gold companies to have exposure to the gold price, surely they'll accept the up and down on the quarterly dividends.
You would think so. You did see a trend really during, I suppose, the bear market where a lot of investors were saying, look, as companies, you pay royalties no matter what happens to the gold price. And so maybe you should be looking at dividends as some sort of royalty back function. And that was really being pushed by Baker Steel out of Australia. And so that was a real focus, I would say, during the bear market where investors were very, very focused and demanding of companies to demonstrate capital discipline because they'd come out of the last bull market in gold where almost every company had overpaid for assets and then you'd seen the dramatic decline in the gold price. And so I think in this kind of environment, you tend to see themes in our sector and companies tend to do what other companies are doing. So I think there's probably less of a focus from investors saying, demonstrate to me that you have capital allocation discipline. And again, moving to the very predictable part of the cycle that you are when you see a dramatic increase in the underlying commodity prices, it moves away from balance sheet focus, capital allocation discipline to where is the growth. And we are seeing a very large increase in M&A, and you're seeing companies getting rewarded for M&A. So you see the outsized performance of Discovery Silver with its Porcupine acquisition and Orla with its Musselwhite acquisition. And that's, to me, that's demonstrating that the market is saying, we will reward you if you can demonstrate material near-term growth and capture some of this idealized margin expansion given the current gold price.
Now, while we're on the subject of capital discipline, I've heard some investors say they would prefer companies to pay out even more of their gold price bonanza so they don't have excess cash on their balance sheets with which to do something stupid with. Nicole, does this argument have any credence?
I think it does, but I think rationality, I think the investors that are very familiar with the cyclicity of the space and understand the risk reward of rapid growth and maybe on unconstrained growth will be saying, we don't want you with your excess cash build on the balance sheet to go out and do something stupid, because if you've been a resource investor for a couple of cycles, you lived the negative repercussions of that. Having said that, you do see you see a thematic shift, and I would say most investors will be, when you see dramatic price rise, will say they'll be focused on growth. And when investors are demanding growth, very rationally, companies will start to grow. And obviously, the easiest way to do that is through M&A. And what you see, and I think we're already seeing the start of this, is as a cycle matures and the underlying commodity price increases, you start to see more and more and more M&A. And then the smarter companies will be buying in the downturns. That's exactly, should be doing deals when nobody wants to do them. But competition begets competition. And so we are seeing more and more single asset companies that have been acquired. We're seeing growth for growth's sake, which is companies combining, getting bigger. There is a positive argument for that because you can generate larger size, more liquidity, more TF buying, and more access to the generalist investor. So again, I think you're going to have this counterbalance. We're kind of at this cusp where investors are saying, we want to see that you have discipline, and the smart investors will be asking for that. But then you see share prices outperform because they have optionality to the underlying commodity price, i.e. leverage beta. And so again, the companies that perhaps have the less strong balance sheets and the higher cost profile have the most exposure to gold, and they tend to outperform in a rising gold price environment. And when you start seeing M&A where companies are using their paper to acquire other companies, then management teams and boards will be sitting there going, well, how do we get some of that talk in our share price? And if we're getting rewarded to grow, then we're going to grow.
Now, you've mentioned M&A about a half a dozen times, Nicole. You're obviously desperate to talk about M&A to some extent. So let's discuss an M&A transaction. Gold Fields agreed to buy mid-tier Australian gold producer Gold Road Resources for 2.6 billion Australian. That's about $3.40 Australian per share in cash. The deal will consolidate Gold Fields' ownership in the jointly operated Gruyere mine in Western Australia. The variable component linked to Gold Road's holding in Northern Star Resources, valued about 88 cents per share. There. If the acquisition is successful, Gold Road plans to issue a special dividend of about 35 cents Australian, some 380 million Australian. Goldfields made an initial bid for Gold Road in March at $2.27 per share. Nicole, Goldfields has increased its bid for Gold Road on 2 or 3 occasions now, but it does seem that the two sides have come to terms very quickly after the initial offer, which doesn't always happen. Goldfields raising its bid by about 500 million Australian over the past couple of months. What does this mean for Australia's gold sector?
I think you're replicating what we saw last cycle, where there was a huge amount of consolidation in Australian gold sector with internationals coming in. And then in the downturn, you saw a plethora of assets being sold, and that then formed the foundation for what are now the largest Australian gold companies. So the Evolutions, the Northern Stars, that really grew through M&A and acquiring assets at the absolute perfect time, buying when you had a lower commodity price environment and buying for, in hindsight, what looked like exceptionally good prices. And so I think we're starting to see that trend again. And I talk about this a lot, and so I sound like a broken record. I think that on average, depending on where you are in the commodity cycle, investor and corporate behavior is very, very predictable. And we're in that part of the commodity cycle where there's a lot of focus on M&A. Having said that, you are also seeing companies, for the Australian gold sector has done incredibly well through the downturn and coming up into obviously very, very strong record gold price environment. And part of that is, in Australia, you have this huge pool of capital that is outsized relative to the population base. And that's partly due to the way that the retirement funding works, which is through superannuation. So you have all of these funds, material amount of money that have to invest in local product. And so you have to some degree a lot of capital with a paucity of product effect. And that is why you're seeing, for the first time, you're seeing companies such as Capstone and other companies that are getting a secondary listing in Australia because they're looking to access that pool of capital. So I think what we are seeing that's a bit unique in this cycle is that companies are getting listed in Australia solely to access some of this very, very large circling pool of capital.
Well, that makes sense, even if it is perhaps a tad cynical. Now, with this transaction, Goldfields is perhaps establishing a bit of a pattern of taking an initial 50% in a big asset. You know, it did the same with Windfall, the Windfall asset in Quebec in Canada, and then later on, subsequently getting the 100%, obviously paying much more for that second 50% than the first 50%. Is this a good sort of level of caution on the part of Goldfields of, you know, feeling its way into an asset before fully committing, or does it perhaps suggest that the management is a little bit sort of gun shy and has a bit of self-doubt there?
I would argue it could potentially be the targets dictating the kind of transaction that they want to see. So in the case of Gold Roads, clearly at the time, I don't think Gold Road wanted to sell the entire company, whereas Goldfields wanted to increase its toehold in Australia. It already had exposure in Australia with the St. Ives operations. So I think most companies would ideally probably prefer to acquire 100% of the asset. But what Goldfields has demonstrated, and I think has made this kind of transaction maybe more palatable, that it can work well with both companies. And so if you looked at the average acquisition price of Gold Roads, for example, then it's a lot lower than what you'd have to pay today, but obviously materially higher than what they paid when that transaction occurred. I can't remember the exact date. So I think arguably it's kind of a win-win. And I don't necessarily think it's just what the acquirer wants. It's also, at the end of the day, you're dealing with a target that it's a negotiated transaction and a target that might have a particular desired outcome.
Now, Goldfields is having success in Australia, less so in Ghana, where Goldfields and AngloGold Ashanti agreed to pause discussions on a proposed joint venture that would have combined their neighbouring gold mining operations, Iduripriem of AngloGold Ashanti and Tarkwa of Goldfields. The AngloGold Ashanti's mine is just 10 kilometres from Goldfields mine. The two companies initially announced their intentions to merge the neighbouring mines in March 2023. The pause will allow them to focus on maximising performance at their respective sites independently, while AngloGold Ashanti works to consolidate improvements in its long-term mining plan, currently considered its most valuable option. Nicole, this JV seems to have been announced an eon ago. And at the time, I recall it was thought that it was perhaps the Ghanaian equivalent of the Nevada Gold Mines joint venture, which was established in 2019. Is this deal perhaps a victim of high gold prices and each side perhaps no longer needing the other?
Obviously, we don't know because we're not in the boardroom, but clearly when gold prices increase and you're building cash on your balance sheet, and as you said, a higher price will paper over a bunch of operational ills, you tend to have a lot more confidence about your path forward. So I would expect the gold price had something to do with it, but also the idea of JVs, you have two sizable companies that each have their own way of doing things, that each have a particular strategy. And sometimes the idea of working together, which on paper probably makes a huge amount of sense. There is opportunities from a cost perspective, from consolidation, et cetera, but then the reality of working through that can have added complications. And so perhaps that has something to do with it as well. And look, in my opinion, Ghana is actually quite a tough country. And the way that the Ghanaian, and it's not enshrined in law, but it's accepted practice is in Ghana, you get paid in US dollars. It's in SETI that gets converted converted to US. And so you don't ever have the currency wins that you get in other countries. And then there's a tradition of essentially getting higher labor rates every year. So Ghana is, in some ways, I think, even though it's probably considered Africa light, it's a complex and challenging country to work in from a labor relations point of view and from a cost structure point of view.
Surely those would all be factors that would make a merger make even more sense. And I bring to mind, recall that the Nevada Gold Mines joint venture, Barrick and Newmont, were dancing around each other for years, if not decades, before that finally consolidated. It seems perhaps AngloGold Ashanti and Gold Fields are perhaps going to enter into a similar dance here.
Yeah, and at the end of the day, you've got egos. So, and often you want one group wants to have more decision-making power and more control than others. And so I think we see this time and time again in our sector. There's very, very sensible M&A, for example, that should occur, or deal structures that should occur. And when you dig into the details, why most things fail, it's due to people.
Damn these people. This is why we're going autonomous, isn't it? And AI. Okay,
exactly.
Let's switch to copper. Lundin Mining has unveiled Vicuna as the biggest discovery in 30 years. With its partner BHP, they announced that their Vicuna deposit in San Juan has an initial resource estimate, combined resource of the Filo del Sol and Jose Maria deposits. Updated resources there. It now hosts 28 million tons of copper, 81 million ounces of gold, and 1.5 billion ounces of silver across all resource categories. Vicuna is now bigger than Elvis, it seems, and it has a similar scale to Cerro Verde in Peru, Collahuasi and Escondida in Chile. It's also one of the world's largest gold and silver resources, which gives it a higher precious metals content than most other large mines. Nicole, wow, some jaw-dropping numbers there from BHP and Lundin Mining. As a geologist, what are your thoughts when you look at this news release?
Look, an amazing discovery, and we have been in the last, as their own promotional material said, and I think you said, the biggest discovery in 30 years. From a geological perspective, congratulations to the team. An absolutely exceptional job from the Lundin family of companies, and I think they're starting to show a track record a little bit like Robert Friedland, which is when you put a lot of money into the ground in drilling campaigns, you have a very, very strong technical team, new discoveries can be made, and you don't have to recycle the same probably underwhelming projects that you tend to see in this kind of environment. So exceptional job. I think the challenge is location. Obviously, it's at a high altitude. You're going to have complexities of dealing really with two countries ultimately, and it will be high capex and a number of other things. But look, it's a wonderful discovery, and congratulations to the team.
I guess at one level, it's great to get some real excitement into the base metal space, the copper metal space. Discoveries have been few and far between, particularly big ones, meaningful ones. And so this does put some more energy into the sector, I think. People have speculated on how much developing these deposits would cost. But I would say that with 81 million ounces of gold and 1.5 billion ounces of silver that you could possibly stream, that could go an awful long way to covering a multi-billion-dollar capex.
Agree. The streaming option, obviously you never want to put a stream or royalty on your primary commodity, but you have a plethora of precious metal streaming companies out there that are tending to trade at premiums to NAVs. And I would argue it's probably a relatively low dilutive form of financing. But these are two very, very large companies that are looking to finance this. And so I think their cost of capital will be materially lower than some of the junior developers that you're seeing in the space. Obviously, one of the challenges that they will have, it's a high arsenic ore, and so it's how do you deal with that?
Talking of the arsenic, the question came up during the conference call when they were talking about this, the release of this resource. From the conference call, it seems that blending high arsenic ores with low arsenic ores may be a large part of the solution. Obviously, they're still doing a lot of research into that. Is that a good solution, or will that only partially resolve the issue? Even if they're able to sort of blend down the arsenic content, is there still the issue of, okay, who's going to accept this? Who's going to process this?
So as you and obviously many people watching this are aware, high arsenic ores, the issue with high arsenic ores is smelters either won't accept them, or they charge very, very punitive charges for the deleterious elements. So the way that is dealt with it is definitely downblending. What we are seeing is a trend globally towards higher arsenic ores. So this problem is here to stay and is probably only going to get larger over time. So ultimately, yes, you can downblend. Jose Maria does not have the high energite component, which is the arsenic mineral, the arsenic copper mineral that predominates with the phyllo assets. So it's not just, and I don't have enough detail, and this will be probably fleshed out in the technical report of the ratios that you would need. But that is, and this is why traders make so much money out of doing deals with companies that have got more high arsenic ores, is that you're downblending that. So there is absolutely, that is the standard way of doing it. You can do some more complex processing routes, but that would be a material capex and opex cost, we've talked about Hot Chili before, but I'm a former director of Hot Chili and a shareholder of Hot Chili as well. But Hot Chili, for instance, has very low arsenic ores, and so you have in the area, in the Vicuna area, you have some deposits and some development projects that could be suitable downblending options as well.
If my geography is correct, Hot Chili's Costa Fuego project is pretty much due west of the Vicuna district.
It is, and I had a quick listen to the call, and they are talking about obviously water longer term. How do you deal with the water issue? So they have their own desal plant. They have access to a port. Is there some way that you can consolidate in the area long-term water solutions and power? And I think one of the ways you're going to have complexities of dealing with two governments and two countries, with Chile and Argentina. And I think one thing that you could do is if to help facilitate support from the Chilean side, because if you're going to export your concentrates down to the coast to exit through the port, and you might ultimately want to have a desal solution from the Chilean side, is to also talk about building out water infrastructure that can benefit local communities. And so we're in the very, very early stages of this, but these are world-class assets that will generate material economic benefits for both countries. You've had a very dramatic sea change in Argentina in terms of their level of enthusiasm for developing the copper projects, and obviously they've seen what's happened on the Chilean side. I was at a conference last year in Mendoza, and you had 5 governors from 5 of the provinces that have material, either existing known copper resources or high potential from a geological perspective, all participating in a panel. And I would argue, I've not seen that anywhere else in the world. I don't think you would see 5 premiers of states in Australia or provinces in Canada getting together to have a discussion about how do we incentivize investment into our provinces. And so for me, that was probably the clearest leading indicator that the Argentine, not just at a federal level, but at a provincial level, is very, very pro getting increased development into the country on the mining side of things.
Absolutely. Sticking with copper in Latin America, China continues to move in on copper gold deposits. Cordoba Minerals agreed to sell its 50% interest in the Alacran copper gold project in Cordoba, Colombia, to Veritas Resources for $88 million US in cash and a potential $40 million US contingent payment. Veritas currently owns 50% of the project, and it is a subsidiary of JCHX Mining Management. Alacran has a 2023 feasibility study for the production of about 24,000 tonnes per year of copper, 37,000 ounces of gold, and 357,000 ounces of silver over 14 years, following a $420 million US capital investment. CMOC recently said it would buy the Lumina copper gold Cangrejos project in Ecuador, while Zijin Mining has been wanting to buy into Solaris Resources and its Warintza project in Ecuador. Nicole, are all these separate companies looking to do deals in Latin America? Is that just coincidence, or is there a pattern here of Chinese companies moving into Latin America for copper resources?
I would argue there's absolutely a pattern. China takes the longest term view, I would say, has a 50 to 100 year view in terms of access to resources. And that's not just on the mining side, it's on the smelting and refining side. And so China currently smelts and refines over 50% of copper concentrate globally. To put that into context, the US is less than 2%. We have seen a dramatic decline in treatment charges and refining charges recently, and for a small point in time, they went negative. So what does that say? That says that smelters and refiners are very, very concerned about security of supply. We know that primary copper production starts to decline materially from this year. So what China is doing, which is what I think China always does and is very, very predictable, is taking a very long-term view and says, we want to secure supply. They are unwelcome. Governments of Australia and Canada and the States has made it very, very clear that Chinese investment into resources within those countries is very unwelcome. And so where does China go? It's going to go to other countries that will welcome the economic investment. And we've talked about this before, I think, Paul, but you've also seen, I would argue, very material Canadian government overreach, which is not just dictating investment in assets within your own country, which is fair enough, but saying to Solaris, you can't have material Chinese investors in or have a company that's interested in acquiring asset when your assets are elsewhere in the world. And if I was the Ecuadorian government or some of the other governments, we've seen this in the critical mineral space, I'd be saying to Canada, who are you, Canadian government, to tell me what to do about the development of my assets when it can result in a material economic injection into the country. So this pattern of China buying and investing in critical minerals complex, and copper is the critical mineral, that's going to continue, in my opinion. And the rest of the world, no matter what you think of Trump, so I'm just going to segue slightly here, no matter what you think of President Trump, the one thing that he has done, I think, is he's kind of forcing this discussion about resource nationalism in terms of security of supply, not nationalizing your assets, but how do you ensure security of supply? And China has been the first mover in this and has taken a very, very long-term view, and that will continue. So I think the rest of the world needs to sit up and take notice and start investing in not only mine security of supply within their own countries, so resource development within their own countries, but understanding at the end of the day, you need downstream processing. So it's okay to mine the stuff, you then have got to smelt and refine it.
I think one of the interesting aspects of this, Nicole, is given, as you say, copper is the critical mineral just for economic development in general, but also you've got all these energy transition applications, the electrification of everything, all demands and depends on copper. China, obviously the most aggressive in trying to lock up future copper supply. And one could argue that it's potentially not competing against anybody because nobody else is really trying to get in and do it to the same level or the same degree as China is. Canada isn't, the United States isn't, although that may change under Trump. The European Union isn't. Why is China the only big economic bloc, let's put it that way, that's really making a move on copper?
Well, I mean, there's a centralized government, and so this is the trouble with a democracy, is democracies are very, very messy, and you have an inability to get things done and get things done quickly in many ways. And mining is, and this is partly the fault of the mining industry, but mining is universally unloved. And you know, as a politician, that being tough on mining isn't going to result in voter loss. And so I think what China has done, and very, very clearly done, and this shouldn't be a surprise, is sat back and gotten the mainstay of civilization as we know it today. It's having security of supply on key commodities. And this isn't a recent realization. I mean, from 2000 to 2025, they increased their smelting and refining capacity by 97%. You tell me any other country that could make that decision, number one, that has this very, very long-term view and then can act in accordance with that long-term view. And so what you're seeing, I think, is the rest of the world starting to finally realize that mining supplies your stuff, and without mining, life ceases to exist as we know it. But there's such a lack of education in decision makers from a regulatory perspective, in our politicians, and they're kind of all running around like chickens with their heads cut off going, well, we kind of know that we need to secure supply, we know that we need to support new mine builds, but I think there's still such a lack of knowledge and awareness about this key issue, and China, which I would be doing if I was China, is taking advantage of that.
Well, I think over the past couple of decades, you've certainly seen the Western countries quite happy to export what they would say as environmental liabilities to China related with smelting, and perhaps that chicken is coming home to roost. Let's stick with copper. Resolution Copper, which is Rio Tinto's and BHP's joint venture project in Arizona. Big project there, 40 billion tons. President Trump wants this to get into development. It put it at the top of his list of projects that would, get Fast 41 permitting as part of his immediate measures to accelerate American mineral production executive order. However, there may be a wrinkle there, as a federal judge said he will rule by May 14th on whether to block the Trump administration from undertaking a needed land swap. What's at stake here? Some Native Americans fear that a 2,400 acre land swap, which may occur before the US Supreme Court decides whether it will hear an appeal to block it. The land swap includes the Oak Flat area that the San Carlos Apache believe to be a religious site. Nicole, you spend a lot of time in Arizona. What is the feeling on the ground towards the Resolution project in the state?
I think with anything like this, it's very, very hard to rely on an indication of local support or lack thereof based on local media, because it tends to be that the noisiest voices, and they're commonly a minority, get the most airtime. My husband and I actually went on a geology nerd trip back in, I think it was 2022, and we drove around and visited some of the copper development projects. And we actually stopped by Resolution because you can drive up to there, and there'd been so much noise in local newspapers and media at that time about the very, very material opposition and First Nations, Native American opposition. And we kind of drove past expecting to see a very large number of people agitating against the development. And what was ironically amusing was there was a single teepee and there was nobody in it. And so I think that the project obviously would supply a huge amount of economic benefit to the local community. It would help the state in terms of its independence from a primary copper supply. It would need to build out refining infrastructure. But we live in this world where there is arguably a bit of Trump derangement syndrome. And so whatever President Trump says, you get what I would argue some people who are normally very rational that immediately take an opposing viewpoint, even if the basis of what he says has some value. And so the way that the American tort system and legal system works is that you can tie projects up like this, and obviously a land swap that will be contentious, would have been contentious if it was Biden that was doing it, but having Trump pushing for this, I think adds an extra layer of emotionality to it. And so I would expect that you could potentially see this tied up in the courts for years and years and years. And so you as a company, you also have to go, okay, if there was a ruling in my favor for BHP and Rio Tinto to move ahead, what happens at the next election cycle, which is less than 4 years away, and if the Democrats get in? And so you did see both between the left and the right in the States that there were certain things that Trump had put in place, and then Biden had immediately reversed, and things that Biden put in place that Trump has immediately reversed. So you have this, at the moment, this political fighting in the States, which is very, very overt and emotional. And I would argue that both parties need to step back, and the American public needs to step back and go, how do we position ourselves in a global context in terms of having security of supply of key commodities that form the foundation of our society. Otherwise, we really do become beholden to China. And I would argue you don't really need to fight. I mean, we are fighting wars, but you don't need to fight wars. You just have to withhold whether it's rare earth minerals, which obviously China controls, or other key commodities. You can control countries' ability to survive and exist by withholding key commodities from them. So it's going to be pretty interesting times over the next decade.
Definitely, people and egos again, and it seems like there may not be a prompt resolution to this particular issue. I think one thing that was interesting is the US federal judge who's said he's going to rule by May 14th. I believe he previously ruled on the project, and I can't remember exactly what it was. Either he denied an appeal, or he allowed the project to proceed. So interesting that he's showing his head again. Let's end with some financing, Nicole. i-80 Gold has entered into a bought deal private placement at 50 cents per unit to raise $135 million to support its development plan in Nevada. i-80 has been laboring under working capital issues, ending the March quarter with a $40.8 million US working capital deficit, leading it to obtain a $12 million bridge loan from Ormet. i-80 aims to develop 5 gold mines capable of eventually producing between 400 and 500,000 ounces per year within 10 years in Nevada. The quantum of this raise falls short of the $400 to $500 million of recapitalization that Chief Executive told me at the end of last year that the company would need. Nicole, i-80 has needed recapitalizing for quite a long time. Does this financing provide the money it needs to really get going and deliver on what it's been promising for the past few years?
It is a very material financing given the size of the company. I think they've issued about 60%, they will, of their equity again. I think they did exactly the right thing. You see too many companies, and some of those that can remain unnamed, that have recently, in recent years, gone bankrupt, that they do death by 1,000 cut financing. So we raise 10 million, we keep the lights on, and all you do is kick your working capital problem down the road, and then you ultimately tend to exacerbate the existing issue. So I think the size of this initial financing, and yes, I think it was very predictable that it was going to come. It was at a discount. There's a half warrant attached. I think that was a very, very, very sensible first step. I think given that where we are with the current gold price environment, this is an American story. US investors tend to be biased towards homegrown stories. It's in Nevada. You can demonstrate their promotional materials focused on, look at this exceptional growth, embedded growth that we have, and we can grow to 500,000 ounces a year in Nevada. So I can see that this is the kind of investment thesis that would resonate with investors today that want to take on some risk and get exposed to gold. It's got growth. It's in the States. We've now de-risked the balance sheet somewhat. Having said that, these are very challenging assets. They're refractory. They're going to be toll milled initially. The autoclave isn't due to be up and running until 2028, and that growth to 500,000 ounces is going to take to 2031. So there are, I think, a bunch of challenges and issues. But if you remove that immediate balance sheet pressure, it does allow management and the board to focus on what they need to focus on, which is advancing these assets. So I can see you've got the equity side that's been dealt with. There's demand out there to be exposed to gold and to gold projects. So if I was the company, I would de-risk my balance sheet as much as possible, engender interest in the stock, hopefully get your share price moving, trade at a premium, and also maybe further down the road, de-risk your asset base if you are trading at a premium by combining with something else.
Well, I imagine i-80 shareholders will be quite thankful for the fact there may not be another financing coming for the next couple of years. The stock's down about 10% today. It hasn't gone all the way down to that 50-cent level. It's trading about 54 cents now. But that's, I guess, one of the disadvantages of doing a bought deal. You pretty much always have to give the people buying a substantial discount. And I think MB Financial and Cormac are the lead organizers or arrangers there. So good job for them. That's all we have time for this week. Nicole Adshead-Bell, thank you very much for joining me today.
Thank you very much for having me, Paul.
And of course, to our viewers, if you like what you see, don't forget to hit that subscribe button. I'm Paul Harris, and this is Kitco Mining.